Hello and welcome to this webinar on Minerva Analytics 2026 Proxy Season Preview, our annual look ahead at the themes and developments shaping the stewardship landscape. The 2026 season is already coming into focus with fresh regulatory shifts, evolving investor expectations, and the number of emerging trends that we think will influence voting and engagement in the months ahead for sure. Today's discussion is going to highlight the key insights from Minerva's preview, explore what they mean for investors and issuers, and also consider the practical implications for stewardship teams preparing for the year ahead. I'm Alex Whitebrook, Independent Advisor to Minerva Analytics, and I'll be hosting today's session. I'm joined today by Thomas Bolger, Minerva's Stewardship Team Lead, and Jack Grogan-Fenn, Minerva's Newsletter Editor, who are going to both help us unpack the findings and share their perspectives on what to watch this season.
Thanks, Alex. And looking forward to discussing the upcoming season with you in this webinar.
Thanks for the introduction, Alex. It's good to be here for what will be an interesting discussion given the major changes that have happened in recent months, which are going to have major impacts for the 2026 proxy season.
Cool. Now, to get us started, without further ado, I wanted to start off today with Thomas. Could you take us back to 2025? So when we were pulling this report together, what were the trends that jumped out to you which emerged last year that remain important this year and are continuing this year, and why do they remain important?
Thanks, Alex. So last year, Minerva did publish a briefing looking at the 2025 proxy season, which looked at, say, governance and voting trends across three core selective indices, which covered the UK, Europe, and the US markets. So that report did identify several themes that we expect to continue into this year's AGM season. So just to quickly run through the headlines. So some of these include, so ESG, it does remain mainstream, but it's being increasingly contested, especially in the US due to political and regulatory pressure. While in the UK and Europe, sustainable finance regulation is continuing to evolve, but uncertainty remains there, particularly given a broader shift in focus towards economic growth, competitiveness, and caution over compliance burden. So as a result, the G in ESG has remained dominant as companies are looking to protect bottom lines in uncertain times, and as investors look for well-composed and effective boards to identify, respond, and mitigate emerging risks and opportunities in this rapidly changing world. So reflecting this, we did identify that support for governance-related shareholder proposals actually rebounded in 2025, and that says support for environmental and social shareholder proposals continued to decline. This was particularly observed in the US market, where shareholder proposals are a much more common feature than, say, in the UK and Europe. So in 2025, shareholder proposals seeking enhanced shareholder rights in particular saw success, and these included proposals on supermajority voting, declassified boards, and also the shareholder's right to call special meetings. And this could continue into the coming season. But at the same time, while there's been success there, shareholder rights themselves have actually come under pressure as regulators look to reduce compliance burdens to boost market competitiveness. And this has included, say, relaxed rules around dual class shares, reduced shareholder vote requirements on transactions, greater use of virtual-only meetings, and also more uncertainty and also restrictive policy around shareholder proposals and engagement in the US. So these developments did shape and impact voting engagement in 2025 and are likely to remain influential as we enter the 2026 season. And we'll delve into these various points in more detail during this webinar.
Brilliant. I mean, it has been a tumultuous year in 2025 for all things shareholder proposals, and certainly there's been a lot of ups and downs that I think we're looking to track closely in this season as well to see if these trends continue. So the report, to dive a little deeper, mentions that there were a lot of changes by the US Securities and Exchange Commission, the SEC, which have negatively impacted shareholders. So to kind of take a step back for a second, now that we've set the stage of what occurred in 2025. Jack, I was wondering if you can give us a bit more detail on these policy shifts that have happened with the SEC and what the implications of those could be for the 2026 season.
Since the start of Donald Trump's second term as US president in January 2025, the SEC has made several high-profile rule changes. These are viewed by many as being detrimental to shareholders and favourable for companies. The SEC's shift in stance towards no action requests stands out in particular as likely having the most significant implications for the 2026 proxy season. For many years, companies have filed no action requests against shareholder proposals which they wanted to exclude from their proxy statements and not be voted on at their AGMs. The SEC staff would then respond saying whether they agree with the company's exclusion of the resolution or not. In November, the SEC announced that it would not respond to no action requests during the 2026 proxy season. This marked a seismic shift for shareholder rights and scrapped a long-running precedent. It risks giving corporate management unprecedented discretion in excluding shareholder proposals and sidelining investor voices, particularly on environmental and social issues. We'll delve deep more into the implications for shareholders and companies of this change shortly, but many have suggested that this change could lead to an overall fall in the number of resolutions voted on in the US during the forthcoming proxy season. As you can see on screen, last year the number of US shareholder proposals had already sharply dropped, while the number of proposals in the EU and UK had increased. While the overhaul of the no action request process is probably the most significant change, it's certainly not the only one that the SEC has made. Rule 14A-8 was amended last year to effectively make it harder for shareholders to even file proposals. The revised rule increases the amount of investment that investors must have made into a company to file proposals and increased the length of time that they must be invested in the firm to do so. It also raised the threshold of support needed to resubmit resolutions. Most recently, the SEC decided to block shareholders that hold less than $5 million of a company from filing exempt solicitation notices on its EDGAR platform. This risks severely damaging vote no campaigns, which have been gaining momentum in recent years. These campaigns were particularly useful for investors to show dissatisfaction at companies where there are no or low numbers of proposals to vote on. These are just some of the changes that have been implemented under the leadership of Paul Atkins. He became chair of the SEC last April and is widely regarded as being a critic of shareholder rights. Under his leadership, the Commission's changes to date have been negative for shareholders, and it appears highly likely that future changes will also spell bad news for investors.
Well, I mean, that's precisely the tumultuous time that I was referring to previously. I think it's going to be very interesting, as you say, to see how these policy shifts are going to impact shareholder proposals and voting behaviors this year. So staying with you, Jack, I'm wondering if you could dive into a little more detail about what impact these changes will have for shareholders and companies and how concerned investors should be, in particular, about the SEC's direction of travel.
So, starting with the SEC's no action shift, it's created major uncertainty for both investors and companies, something that we've written about many times on the Minerva blog, which you can check out on our website. The news about the change seemingly came out of the blue, and there's been really little guidance from the Commission for shareholders or firms about how to deal with the changes. We already briefly touched on the point about there potentially being an overall decline in the number of US shareholder proposals. Some companies seem to have taken advantage of the change to more easily exclude proposals. At Apple, for example, there was a noticeable drop in shareholder proposals this year compared to 2025, though it is worth noting the company did reach agreements with some proponents that saw resolutions withdrawn. Apple has been challenged by shareholders on AI several times in recent years, and AI-focused proposals have secured strong support in the past. This year was the first year since 2023 that Apple did not face any proposals on AI, and it had actually excluded an AI-focused resolution from TulipShare without getting no action approval from the SEC. However, it's important to note that the litigation risk that this has created for companies as well. Shareholders have started suing companies, including Axon, AT&T, and Chubb, for what they feel to be unfairly excluding resolutions. It's highly likely that there will be more such cases in the coming months, especially given that AT&T so quickly U-turned on its decision to exclude a proposal following the shareholder lawsuit. Some companies have decided to be cautious in the face of this risk and opted to include proposals that they previously filed no action requests against. By doing this, companies avoid the increased litigation risk and instead leave the decision of in regards to the proposal in the hands of shareholders. This change had been predicted to primarily impact ESG-related resolutions, but these changes will impact all shareholders, both those with pro and anti-ESG aims. So it's in the interest of all shareholders to push back on these regressive changes from the SEC. The Commission's recent banning of smaller shareholders from filing exempt solicitation notices on its EDGAR platform is also a concern that should cut across political lines. With the SEC making it more difficult to file resolutions at all, Vote No campaigns are one of the most viable ways for shareholders to ensure that their voices are heard by investee firms by galvanizing groups of investors to vote against directors or certain agenda items.
Right, and to that point, now that we've covered the shareholder side of things, Thomas, I was hoping you could fill us in a little more on how investors and companies are adapting their environmental and social stewardship expectations in particular in response to this shifting political sentiment, increasingly anti-E and anti-S. Particularly, are investors changing their approach to holding management and boards of investee firms to account?
So there is very much, say, a mixed picture at the moment. So what we tend to be seeing is, let's say, investors and companies are not only responding to the political and regulatory climate in their respective markets, but also need to navigate a wider set of global pressures, including, say, geopolitical uncertainty, economic volatility, and also diverging international regulatory pathways. So all of these forces are influencing how stewardship expectations are set, challenged, and also being adjusted. But the overarching trend is that stewardship expectations are continuing to evolve as, say, the environment around them shifts. So if we look in the US, for example, due to the shifting political sentiments around diversity, equity, and inclusion, this has actually led some large asset managers to scale back elements of their voting policies on diversity. So that doesn't necessarily mean they're abandoning ESG altogether, but it does show a more cautious tone in how they're, are framing expectations and also how they engage and vote at companies. Companies, meanwhile, are caught between, say, expanding international sustainability expectations and fragmented domestic requirements. So this is also creating a complex and often resource-intensive reporting demands for companies themselves. And we actually have seen some US firms scaling back their diversity disclosures in response to, say, the executive orders in the area. And at the same time, a number of global financial institutions and also oil and gas companies have scaled back their climate ambitions. And this is in response to, say, the complex mix of financial, regulatory, and political pressures. But at the same time, climate does remain a material financial risk and a stewardship priority for a number of institutional investors. So this can create some tensions in expectations between companies and shareholders. Well, when we say we turn to the UK and Europe, so here the regulators have continued to push forward with, say, corporate board diversity targets and also ESG disclosure requirements, although some caution is being shown in regards to, say, reporting and compliance burdens for companies and investors. So investors do need to remain alert to this evolving environment across markets and engage with policymakers where appropriate to help shape, say, an effective stewardship framework and also ensure there's decision useful company disclosures. So at the same time, we are seeing many investors leaning more heavily on governance-led accountability, such as, say, through director votes, and this is to promote, say, well-composed and effective boards with sound governance practices. So instead of, say, relying on shareholder proposals, which, as Jack has discussed, has become more uncertain in the US market in particular, investors can use director votes to push for better oversight on things like climate strategy and sustainability risks. We're also seeing the topics of shareholder proposals evolve in response to this changing environment. So in recent years, there have been more proposals on artificial intelligence And this year, we're seeing proposals being filed, say, on the impact of immigration policy as shareholders respond to the political environment in the US markets.
Right, and I think the AI topic is obviously one that's very interesting. Minerva will be publishing a briefing on that topic in the coming weeks, so please do keep an eye out for that if you're interested to hear more from us on AI and the risks and, of course, opportunities it proposes or it poses to investors and companies alike. But I wanted to hone in a little more, Tom, on the director voting and board accountability side of things. As you mentioned, thanks to Jack's input on the reduced reliability of shareholder proposals as a mechanism, especially around E and S challenges, these director votes and other more governance-focused activities are becoming much more of a point of leverage and like a final backstop for investors. So what are we seeing in this area for 2026 and what challenges are investors facing?
So Alex, director elections are a powerful tool for shareholders to express dissatisfaction on issues like climate strategy and provide an alternative tactic to filing a shareholder proposal or even needing a proposal on an ESG topic to raise the issue via a vote. So there are challenges that shareholders face on director voting. So the first one is that shareholders they may not be actually aligned on who on the board to hold accountable. So some shareholders may target the board chair, while others may target, say, the chair of the sustainability committee. And that can dilute shareholders' voice if they target different directors for the same kind of issue. And additionally, in the US, vote no campaigns actually did seem to increase in 2025 and essentially as a response to that uncertainty around shareholder proposals. So these are campaigns where shareholders file a proxy solicitation urging shareholders to vote against a director or other agenda item due to, say, a particular ESG concern. But the SEC's recently announced tighter rules, which limits these solicitations, do make them harder for smaller shareholders to run at companies. But despite this, vote no campaigns haven't disappeared, and we've already seen a couple of examples in early 2026 of these. So the preview say highlights Starbucks, where a coalition of investors have filed a solicitation urging other shareholders to vote against directors over concerns about labor relations oversight. And notably, at Starbucks, they actually faced shareholder campaigns in this area previously, and this included a successful shareholder proposal at the 2023 AGM. So this again highlights the importance of, say, board responsiveness to shareholder concerns. Well, another one recently of a vote no example is at, say, Jack in the Box, where a vote no campaign by Bolger Capital focused on fair concerns over the company's operational and financial performance. So the AGM was actually held in February. So all directors were re-elected, but the board chair actually was only narrowly re-elected and did receive a large against votes. So another issue which shareholders face on this director voting, again in the US, is that there has been instances where a director who fails to secure majority shareholder support actually remains on the board. And this could be due to a company's use of a plurality voting standard or the use of majority voting standard without a binding resignation requirement. So the preview briefing does highlight some examples of this. And again, it raises that concerns about board responsiveness and also accountability mechanisms. So a high-profile example from last year was at Netflix, where the lead director received only just 21% shareholder support, but has stayed on the board. So despite these, say, shifts around, say, more focus on director voting, it's still important to note that shareholder proposals do actually remain an important part of the stewardship toolkit, and investors still do continue to choose, say, the engagement and voting methods that best suits each situation with, say, consideration of their own stewardship objectives and also the company-specific circumstances. So we can take BP as an example here. So last year, shareholders ran a vote no campaign on the board chair due to concerns over the company scaling back climate commitments. Well, this year, shareholders have filed a proposal asking for enhanced reporting around climate change. But there's, again, issues around at BP, similar to what we're seeing in the US, where the BP board have actually excluded a shareholder proposal from its meeting agenda, saying that the following legal advice, the proposal did not conform to legal requirements. So this does raise concerns over the debate around, say, shareholder rights and the ability to file proposals in the US, also occurring in other markets. And we did actually see a similar case at, say, Total Energy in France, where they excluded a shareholder proposal a couple of years back as well. So here, follow this, the proponents has stated that they intend to pursue legal action if BP doesn't include the proposal. So this is one to watch out for in 2026.
It certainly is. It certainly is a tough time to be a shareholder activist, and as I pointed out, this increasing focus on governance tactics and holding companies accountable, especially here through board and directive voting. It's quite a clear sign of that becoming a final backstop to shareholder rights. So good to hear, though, that there are some good developments on the shareholder proposal side and organizations fighting to keep shareholder rights. So if we kind of zoom a little deeper onto the logical next step here, how are investors then using votes on executive remuneration in particular to reinforce accountability? And are there any emerging trends that shareholders should look out for in 2026?
So remuneration remains an important mechanism for aligning management and shareholder interests. And shareholders often say, when it comes to voting on remuneration, focus on, say, whether the right pay metrics are used and driving the right kind of executive behaviors, whether remuneration disclosures are sufficient, and also whether remuneration outcomes align with performance, and a general consideration, say, of overall quantum and pay levels. And at the moment, due to the uncertain geopolitical and economic environment, one area which shareholders will want to pay attention to is the use of discretion by remuneration committees to ensure there is appropriate pay outcomes that, say, the shareholder experience aligns with the executive experience, and this will be an important part of the discussions. So in 2026, we expect there will be a continuing theme for, say, UK and European companies, where they'll continue to file proposals to amend pay structures or pay levels, particularly increase the executive pay opportunity, a bit more in line with, say, US-style practices. This is driven by debates around market competitiveness, evolving governance expectations, and the need to compete in the global talent markets. So where companies do propose such changes, shareholders are going to be expecting clear, substantive explanations that link why the changes are appropriate to the company's strategy, business model, and long-term value creation. So reflecting this kind of concern, the UK Investment Association's letter to remuneration committee chairs sent out in November 2025 did call for remuneration committees to avoid generic justifications such as simply pointing to market competitiveness, retention, and also simply, say, targeting benchmarking to increase pay levels, and actually provide meaningful and company-specific justifications for why a change is necessary. So investors will be closely paying attention to these kind of explanations, and some may also consider how those kind of changes sit in the context of workforce pay and social equity concerns as well. Well, in the US, one item which we did identify in that 2025 review, which we mentioned earlier, is that one-off awards has remained a big source of, say, shareholder dissent in the markets, and that, say, includes retention, recruitment, and severance payments, as well as, say, exceptionally large so-called moonshot awards, which are very large awards which are, say, tied to ambitious share price, TSR, or strategic milestone hurdles. So we do kind of expect this to feature again in this year's voting season in the US. So when we turn to, say, moonshot awards, the 2018 Tesla award to Elon Musk, which was resubmitted for approval last year amid those legal challenges, is perhaps the most prominent example of that type of award. But we've also seen similar awards, say, granted at Naspers and Prosus, which do illustrate how that structure is spreading and could particularly occur in the tech sector. While concerns over Slade's other type of one-off awards already mentioned what did contribute to several defeats of remuneration reports in 2025, and the early indications from this year do indicate that again these kind of awards are getting granted and will be a feature in the voting season. And in particular, there has been quite a large space of CEO turnover recently, so those special awards may link in with that kind of those changes. And finally, the other key item which shareholders will particularly be looking at is again on that board responsiveness, which we've been mentioning earlier, particularly say where a company has faced a previous high descent on remuneration, shareholders will be looking for board responsiveness and also the remuneration committee to explain how they've engaged with shareholders to understand concerns and what changes they've made as a result to the feedback.
Well, it certainly is an interesting dynamic. I think the best way to describe this back and forth on all of these governance and environmental social issues, or the environmental and social issues becoming less viable for shareholders and having to focus on more these governance, the director voting and the remuneration votes as well. As a way to push change within organizations, it really represents this ESG tug of war that we currently see ourselves in. So it seems that, as you said, and as this kind of these battles over remuneration rightly point out, these governance proposals may become more of a focus for shareholder proposals in the coming proxy season. So to kind of bring us forward again, back to the briefing itself. Jack, based on the analysis in the briefing, what other governance topics beyond those mentioned by Tom do you expect to be prevalent during the 2026 proxy season?
There are several governance topics that Minerva is going to keep an eye on during the 2026 proxy season. Tom's already discussed executive remuneration and remuneration structures, as well as board accountability and responsiveness. Virtual-only AGMs and minority shareholder protections are among the other key governance issues we are going to keep track of in the coming months. Beginning with virtual-only AGMs, the negatives significantly outweigh the positives for investors. There are unarguably benefits that from online meetings that are offered through hybrid AGMs to shareholders, but the drawbacks of purely virtual AGMs are overwhelming. These include limiting the ability of investors to interact with senior figures at companies, giving firms greater control over the flow of information from meetings and the questions asked at AGMs. The number of companies using virtual-only AGMs is on the rise in different countries. In the US, 77% of meetings are virtual-only, which is very high and should be a bit alarming, while Germany, Italy, and Japan have also seen increases in the number of entirely online AGMs. The UK is also laying the groundwork to ease the uptake of virtual-only AGMs by companies, again, something that should be of concern and investors should be paying attention to. Investors need to be following this topic, as the more the online-only meetings are adopted by companies, the more their rights are being put in peril. Minerva Analytics intends to publish a dedicated briefing on virtual AGMs in the coming months, where we will delve deeper into the risks of online-only AGMs for shareholders, as well as why the number of such meetings is on the rise. Concerns around dual-class share structures, more commonly known as DCSS, have also been piqued by recent regulatory shifts. These structures can restrict company accountability and reduce the influence of minority shareholders. The pursuit of IPOs is risking creating a regulatory race to the bottom, with Paul Atkins of the SEC just last month calling for shareholder meetings to be depoliticized as part of his drive to make IPOs great again, which we wrote about on the Minerva blog. DCSS means that boards can consolidate control, reduce minority shareholder ability to challenge decisions, and limit meaningful oversight of governance risks. Investors need to be on the lookout for entrenchment devices like DCSS and their potential impact on board accountability and transparency. We have previously published a briefing looking at DCSS and sunset clauses, which is free to download from the Minerva website. So absolutely check that out if you're interested. And if you have any questions about either of those briefings or any of our other briefings, do reach out to us by email.
Brill, thank you very much, Jack. It certainly is a complicated landscape for shareholders at the moment. But we're going to take a bit of a step back now, and I should acknowledge it looks like we're going to go a little bit over time, but there are a couple more important questions that we want to address. So, Jack, I was wondering if you could help us, take a little bit of a step change, so to speak, and talk about a slightly different but important topic, which is the growing misalignment that we have found, that other researchers in the market have found between asset owners and asset managers in recent years. Obviously, some stewardship challenges are emerging from this misalignment, but I'd like you to discuss in a little more detail what has been found and how significant this misalignment is.
Yeah, so we felt that the growing misalignment between asset owners and asset managers was a really key thing to touch on ahead of the 2026 proxy season. And there are a few key issues here to explore. Recent reviews, including Minerva Analytics' own Horizon Scanning Survey, have identified a growing misalignment between what asset owners expect from stewardship and how asset managers are approaching voting and engagement. Similar to the 2023 UK Asset Owner Stewardship Review, which was instigated by the UK Asset Owner Roundtable, Minerva's market survey on the priorities of asset owners and managers found a particular misalignment around climate stewardship and some social issues. The table that you're seeing on screen sets out the top 3 environmental, social, and governance stewardship issues based on feedback from everyone who took part in the survey. We've also compared how asset owners and managers approach these topics. What stands out immediately is that asset owners usually focus on bigger picture, stakeholder-driven themes, the kind that support long-term value and reflect broader values, while asset managers tend to concentrate more on governance, disclosure, and structural factors. Unless there's better alignment between these different viewpoints, we could see increased divergence and gaps emerging between what asset owners expect and what asset managers deliver as we head into the 2026 stewardship cycle. In some cases, the disconnect has been significant enough for European asset owners to reallocate mandates, which hammers home how important alignment has become. At the same time, managers are facing pressure from multiple directions, including from asset owners, political pushback in certain markets, and legal challenges, including antitrust allegations, which are particularly prevalent in the US. One response from asset managers has been to divide their stewardship functions and offer more sustainability-focused options to European clients, alongside expanding voting choice programs, which aren't necessarily available in other jurisdictions. Voting choice programs give asset owners more say in how votes cast by allowing them to select between different voting policy options, but they are still a minority of activity and can serve to fragment asset manager activity. These challenges also show up in the UK Investment Association's recent report, which called for a realignment of stewardship expectations and raised concerns that some asset owners may have unrealistic expectations of what stewardship can achieve. That's not a viewpoint that Minerva necessarily shares, but that is what the association has suggested. We saw the same tension reflected in responses to the UK Stewardship Code. Some asset owners raised concerns about the reduced focus on environmental and social benefits, particularly the altered definition of ESG and more lenient reporting expectations on escalation and collaborative engagements. If you're interested in finding out more about that, we published a briefing on the Stewardship Code at the start of this year, as well as a webinar. So take a read of that and reach out if you have any questions.
Brilliant. Well, I think this webinar has certainly raised a lot of interesting issues and challenges that shareholders are facing ahead of the 2026 season. Now, Thomas, to close us out here, how is Minerva themselves adapting and navigating the changes in the proxy voting landscape? And more importantly, how are they helping clients fulfill their stewardship duties going forward?
So Alex, at Minerva, our approach to supporting clients and navigating this fast changing proxy voting environment is rooted in what we call stewardship sovereignty. So put simply, it just means ensuring that investors retain full control over their own stewardship priorities and voting decisions. So we've seen the landscapes, they become more politicized, with regulatory shifts making it harder for shareholders to file proposals or even engage on ESG topics. So against that backdrop, preserving investor autonomy is critical. So because at, say, Minerva, we don't actually operate a house policy. Every client uses their own bespoke voting framework that reflects their own philosophy and escalation pathways. So our technology is built around ensuring that client policies are implemented consistently and transparently, even when, say, investors need quite different approaches. Say some more may want more targeted tools, say around director level accountability or votes on climate or other governance related triggers. So ultimately, stewardship sovereignty gives clients stability in an unstable environment. So the confidence that even if the rules are changing, political tensions are rising around them, their voting decisions remain fully aligned with their own mandates, values, and also long-term stewardship goals and policies.
All right. Well, thank you very much to our speakers, Thomas Bolger and Jack Grogan-Fenn, for sharing their insights today. And thanks to everyone who joined us for this session. Apologies, we went a little bit over time. If you've not yet downloaded Minerva's 2026 proxy season preview briefing, we do encourage you to do so now. It provides the full data analysis and the context behind all of the themes and topics we discussed today. So we'll also send a copy of the briefing directly to all attendees after this webinar. If you don't get the chance to download it now, it'll be there in your inbox. Before we close, a quick reminder as well to keep an eye out for our next briefing, which will focus on AI stewardship. I mentioned it a little bit earlier on in the webinar. It's due to come out in coming weeks. This briefing is going to really dive deep into how AI is reshaping stewardship practices, risk oversight as well, and the expectations for investors and boards alike. So thank you again for joining us, everyone, and we look forward to seeing you next time.